Good afternoon, everybody, and welcome to the monthly Tax Investigations webinar. Today, we are going to be talking about the rise of investigations post-COVID and post the budget last week. So we're going to cover a few points that were announced in the budget last week. Imad and myself will talk about these points in the next 20-30 minutes of this webinar. So thank you very much for joining us today, and also if you're watching the recording, thank you for subscribing and watching this recording. If you are live, then you can enter your questions in the box on the bottom right of your screen, and we will try and cover a few questions at the end of this presentation. And so thank you for listening and watching. Without further ado, let me start this presentation. So today you've got me, Dave Jennings, and my colleague Imad Ilyas. I'm an ex-HMRC Inspector of Taxes. I spent nearly 20 years in the Revenue and Customs investigating individuals, large businesses, multinational corporations and the like. I also qualified as a Chartered Tax Advisor in my spare time, and then was headhunted and jumped ship in 2006 to join the profession. And the last 15 years, I've been working at a number of accountants, top 10 and specialist firms around investigations, helping clients with revenue inquiries, right up to criminal cases and expert witness in the courts and tribunals, and also making plenty of voluntary disclosures, which is always the best way forward. If you approach the revenue first, you reduce your penalties and you've got some certainty and less stress. So at Churchill Tax here, we provide tax advisory work, tax planning, in addition to tax investigations. And these webinars are alternated on a 2-weekly basis where our tax advisory colleagues talk about the latest issues on planning and tax technical points every other week compared to ourselves. And we do a monthly webinar on investigations, and we cover every type of HMRC investigation or disclosure that you can pretty much think of. So today it's post-COVID, what's happening next? And we're going to cover a bit on the latest HMRC statistics, a reminder of the nudge letters, which we've covered in previous webinars, but there are a number of other nudge letters that HMRC are issuing at the moment to taxpayers to encourage them to come forward before revenue open investigations. As I mentioned earlier, we will also touch on the points that came up around investigations and compliance activity from the budget last week, and some other HMRC revenue changes. So some of these statistics are quite interesting, and you can see that inevitably as investigation staff in HMRC have maybe in the last 12 months been moved into providing COVID support work to taxpayers and businesses around the country, that the compliance yield was forecast to go down in the next 12 months because they've not been opening quite so many cases last year as they normally would do. And the yield again from that will also drop, or is projected to drop in the following year. We will see, obviously partly on this slide, but equally later on as well, that to combat that, HMRC are putting in more resources to obviously catch up with the drop in the compliance yield. This is just the standard compliance yield, not the sort of big investigations that they do in tackling avoidance and evasion. Generally, most of the budgets that the revenue set are often 5 years in advance, and on average they tend to have a target of collecting an extra £2 billion every 5 years. That's extra from the work that the avoidance and compliance teams undertake over and above their standard compliance activity and investigations.
Sorry, Dave, just on this, this is quite interesting, and it certainly is the precursor to what's about to come. Now, there is a drop in yield, a significant drop in yield, and add to that, they have given out a lot of support during COVID times. So, I mean, I don't want to jump the gun in terms of what's next in the slides, but it all points towards the fact that there will be there will be measures taken by HMRC to recoup some of these yields and to recoup wherever there has been, say, some sort of support that has been claimed or it shouldn't have been claimed. So HMRC will be looking to put in place measures to recoup all of that.
Indeed, absolutely, Imad. And what also has to be noticed is that there is always going to be a time lag between the revenue opening investigations and inquiries and then being settled with the yield from the activity. So where these targets are aimed at the increased yield, the forecast yield there of an extra 1.3 billion by 2025-26. That's a huge amount of extra compliance tax to be brought in. Many of those inquiries will be maybe starting in the next 12 months for some of those cases, which can take maybe a number of years to actually reach a settlement. Or if the cases end up at tribunal, for instance, then again it takes a long time for the revenue maybe to bring in that yield if there's some arguments that all counts towards the compliance activity, and there is inevitably a time lag. So what accountants and clients need to be aware of is the tax returns that have just recently been submitted for 1920. They are certainly going to be targeted potentially over the next 12 months. And equally, probably what is inevitable is that the 2021 tax returns are also going to be highly looked at, and we'll cover one of the reasons why when we consider the COVID situation, because any grants and payments that people have received in 2021, they're going to be under the microscope for the investigations.
I mean, that's a very good point in the sense that what are the things that we should be looking out for? And I think certainly in my experience and yours, we've seen that during this COVID period, we've seen a mixed bag. So some inspectors would be more flexible in terms of reaching a settlement, but then others would continue to follow the route that they've normally done. If they are stuck on a point, they will be stuck on that point. But what certainly needs to be done is if you feel that there is an error, if there is something that needs to be corrected, it needs to be done as soon as possible, because what I anticipate is once we are out of this COVID period, right now there is a bit of flexibility in the sense of getting acceptance of resolution, reaching a settlement. Some cases are being closed, but once we are out of this COVID period, HMRC, I'm expecting the stance will change. So it is, if there are things that need to be fixed, I would suggest that people do that as soon as possible and not leave it.
Yes, if you know you've made mistakes, if you know there are errors, the revenue currently may have had a lighter touch approach and a bit more sympathy during the lockdowns and COVID, but certainly come summertime and going forward, that relaxation or light touch approach by the revenue will disappear, and the revenue will be far more aggressive in trying to bring the tax receipts back up again to recover from all the payments that the government have been making out. We all know from the budget that eventually these payments have to be clawed back by the government to balance the books, and people will be under a lot more pressure to ensure things are correct and accurate, and penalties no doubt will equally continue to go up. So how are they going to do this? I mean, we've already seen, and so we've covered some of this in previous presentations, what's known as the nudge letters, and this is from the behaviour teams where the HMRC are using the information that they have from the massive Connect database, which can be from letting agents, land registry, third-party information, bank information, all sorts of data goes into that system to check against tax returns. And if there's any risk there that the tax returns are not or don't appear to be accurate and fully disclosed, then it's in lieu of opening an investigation, the Revenue may issue what's known as a nudge letter to warn people that if you don't check your tax returns, whether it's accurate or not, then we will open an investigation. So where we've seen the Worldwide Disclosure Facility, WDF campaigns, that's where the Revenue received information from overseas territories under the Common Reporting Standard, the CRS. Lots of financial data has come in from 80 to 90 countries around the world. We've particularly seen in the last few weeks a lot of Italian clients come forward to ask for help and assistance. The Revenue, whether they're going country by country basis or it's just a bit of a coincidence, it varies. You know, we've helped clients with German, French, Canadian, American, Singapore, India, quite a lot of different countries, and say Italy more recently. So the Revenue are working through that data to issue the nudge letters around offshore income.
Yes, sorry, Dave, I just lost internet.
Okay. Thank you.
On these nudge letters, I think we covered them.
We've covered them a lot previously, yes, in detail. What I did want to do is just mention equally there that in addition to the let property and the worldwide disclosure campaigns, the Revenue have also issued
to say,
letters.
Well, I'll wait for it to be escalated. It should never be that case. Even where you've had wrong and they've sent a nudge letter to someone who doesn't have anything to disclose. Even in that, you don't just tend to, there's a way that you get back to HMRC. Because if the answer there is not satisfactory, they might progress it to the next stage, which is comes out of it. But what will go out from you is the energy and the costs in dealing with them, because it hasn't been dealt with at this stage clearly. And so our advice always is for clients to make sure they check things, and if there is anything to be that there have been errors, can come forward, and these there are facilities that we can put clients through, which essentially help them come clean and get their tax affairs up to date.
Yes, indeed. I think you broke up a little bit there, Imad, on your connection with Mr. A fraction, and I may have covered in for you, or depending how this has gone out to everybody else. I'm not sure if I talked on top of you for a little bit there, but hopefully your connection will stay constant for the rest of this presentation. What we've also we are aware of is HMRC have issued these nudge letters checking on people's residence status that they've declared on tax returns, or if they've breached the deemed domicile rules that came in since 2017. If you've been in the UK for more than 15 years, then you'd be treated as deemed domiciled for later years. They're also issuing letters around checking on people's self-assessment declarations for employment income, pension income and benefits in kind. Some people have not included all of that on their tax returns. And equally, the Revenue are catching up on all those people who've maybe not submitted their 2017-18 tax returns yet. So people do need to catch up with their tax affairs, otherwise it can end up with a full-blown investigation. So turning to some of the announcements in the budget last week, and we're not covering any of the tax technical points that came up in the budget. We are just specifically looking at HMRC's figures and targets and changes that are looking to collect in the extra monies that have maybe been lost through COVID, and also to resurrect the compliance and investigation regime that the revenue may have moved staff into the COVID support arrangements, which obviously has been fantastic. Short-term help and assistance for many businesses. We know there are some people who've not benefited from any of the grants, recently self-employed, directors of personal companies. They're still trying to get some support. So it's not been a fair package maybe across the board, but obviously the revenue have pushed out a lot of time and effort in getting things done very, very quickly. Inevitably, the speed may result in increased levels of fraud. So as a recognition of that, the government are investing an extra 1,200 staff to combat fraud from COVID-19. And that means looking at the self-employed grants, the furlough payments, and bounce back loans as well. So that's probably one of the biggest investments in spend that the government have ever put into compliance activity. So that is a huge investment, and I guess a recognition that they think that fraud might be quite high. In the more serious cases, HMRC can prosecute, they can take criminal action against COVID fraud payments, COVID fraud grants. We have seen people arrested for COVID fraud. There are estimated to be around about 10,000 ongoing cases at the moment, covering all these various grants. Another surprise or another new point, I mean, there'd been a consultation around this a couple of years ago, and that's the use of electronic sales suppression software and hardware. And the revenue asked people and companies, businesses, software manufacturers, hardware tool manufacturers, EPOS arrangements, how could they tackle this increasing risk to the tax base of ways of manipulating electronic sales to reduce turnover, which is tax evasion and fraud. Generally, it's found to be more prevalent in small retailers, takeaways, and some of the hospitality industry. The revenue looked at making it mandatory for people to use particular software, or to change the way that the software providers retained that data to see if the information had been manipulated, if the logs had been changed or not. And ultimately, I think they've concluded that they are either too onerous to force people to buy specific software, or stop any flexibility if logs need to be changed because there's been some genuine mistakes as well. So instead, what the government are going to do is introduce new powers to make it illegal and an offence to own or use or manufacture or distribute ESS software or hardware to any business, individuals, companies. So that will become an offence for anyone to distribute it or to own it or to use it. So I guess everybody is on notice there that it's not just the end user of these manipulating tools, it is also the people who may be looking to gain financially in selling them to traders as well. You might be interested in this.
Sorry, just on that electronic sales suppression software, it's about time that something like this has come about, because you have to sort of stop it from the source of where it's starting. And I think that all of these points, you will go through them. It just goes to show what we've put in the previous slides, and especially the COVID-19 fraud. We've seen many cases. You were mentioning it as well, Dave, that with your experience, you've seen whenever the government goes and gives out a lot of support like this, there will always be measures introduced later on. So whenever we spoke with clients on any of these, on the bounce back loans, on the furlough, it always make this clear to say that you don't just think that you would just get this without any checks later on. So if you have to be absolutely sure with the figures that you're putting in. I mean, I guess with the bounce back loans, a lot of people might be thinking, well, yes, if I'm paying back the loan, is that enough? Because I'm not really defaulting on the loan and it's being invested in the company. It's being used to help the company grow. These are some of the things that people will be looking at.
Yes, and if people need advice, then they need to contact us or your own local accountant to ask what to do, and certainly we can help and assist. You may be interested in this other point. I know you specialise in this, Imad, about the R&D cap. It was announced last year in last year's budget. Obviously, it's coming in now from April 2021. It had been postponed from April 2020, so there's going to be a cap on SMEs claiming R&D tax credit. For most SMEs, it may not really have a big effect. The average claim is around about 50,000. So if you've got the 3 times pay-as-you-earn cap as on top of the 20k, then for most people it won't. They won't necessarily be affected. If your claim's less than 20k, obviously that's going to go through as normal. If your qualifying expenditure is more than 60,000, then you may be affected by the cap. Obviously, you would then have to look at what your pay-as-you-earn spend is to then check the cap. But obviously, it's an area that's been brought in to deter abusive or false claims or exaggerated claims for R&D.
I think some of our clients will have, for the ones that are working on their qualifying expenditure, sort of puts them at a disadvantage with this new measure, because it's kind of placing a cap on them when they've got all the qualifying expenditure. They've got also, they tick all the boxes. It is a legitimate claim. Everything is there. They've spent a lot of time, resource, and we've got all the backing. So while it will work for a lot of them, I think there will be some that will feel that they're at a disadvantage with this measure.
There's bound to be some people who will maybe be restricted in what they can claim. Obviously, it's for those who've got loss-making scenario. So it is, it's the startups, it's the businesses that are spending a lot on R&D at the beginning of their trade, which could be affected on making those tax credit claims.
Absolutely.
So some more items that came in the budget. These a little bit more for the future and areas that people may not come across too frequently. Starting at the bottom, follow-up notice penalties. They've always been a minimum of 10%, up to 50%. There's been a lot of people complaining that it's not fair, that if you genuinely dispute an arrangement and go to the tribunal, but if you lose the case, you end up with a potential big penalty of 50%, or if you even back down and then settle, but don't settle till after the follow-up notice deadlines, then you could be facing big penalties. But the revenue, what they've said is, yes, we'll reduce that penalty then from 50 to 30. That doesn't, it's not really going to be a massive reduction, because many people might not have had the full 50% anyway. But what they are saying is they'll then add another 20% on top if you lose the litigation and the tribunal and the revenue actually decide that the litigation was unreasonably sought. Basically, you had no chance of success, and therefore they will issue extra penalties. It's obviously to deter. And many people in the profession have said it's deterring the right to challenge and the right to legal representation in tribunals by issuing a penalty to stop people from taking the case. Some people might say, well, that's stopping the legitimate right to defend an issue. That's obviously a strong argument against it. Equally, I would guess that if you are very positive that your planning arrangement is 100% correct within the law, then why not defend it in the court, and hopefully you would win. We do know statistically the revenue always quote about 93% of cases are in their favour to do with disguised remuneration and tax avoidance. Those statistics, like most statistics, will depend on what goes to the tribunal. What is never seen is how many cases the revenue may be settle on outside of court, outside of the tribunal. And agree an element of the tax planning does work. Obviously, they don't impact on the statistics. On a linked point of that as well, around avoidance and planning, we know there's the POTAS, Promoters of Tax Avoidance scheme, where penalties can be charged on promoters. They're constantly changing the rules and trying to make it harder and harder for people to promote tax planning. Many companies who purely have specialised in tax avoidance arrangements have folded and closed down, but there are still promoters around. So the revenue wanted to increase the measures to tackle this. And a couple of things that have been announced are that they've put beyond doubt that Schedule 36 information notices will apply to tax planning and to promoters. Equally, they're increasing the penalties for enablers of tax avoidance, which means an enabler could be anybody in the chain. So if you're making these things happen, if you're promoting them, selling them, or if you're devising them, you could be caught within these rules. Obviously, it's tightening up that sphere of tax avoidance. There is still maybe some grey area between what is tax planning and what is tax avoidance, and equally the revenue have always tried to muddy the water a little bit, and some of the press have muddied the water about evasion as well. Tax planning, tax avoidance is legal unless it's against the rules and the law. So the courts and the revenue have always moved to argue that it's not just the strict ruling of the law, it's also the spirit of the law, which they don't like. If somebody is bending the spirit of the law, I think many people would say, well, if you can't one person's view of the spirit is not necessarily another person's view of the spirit. So that's a bit of a grey area to try to pursue down. But obviously the courts will now rule to say that if generally there's not an economic reason for a transaction or for a step or a planning, then not a commercial reason, and the tax is the only main reason, then you could be caught by any anti-avoidance rule, or any of the disagreements with the use of the law, any loopholes. If the steps are not commercial, then they could be ignored completely. So the purposive arguments, and that's where the spirit of the law in effect comes down and clamps down on these points as well. So they're just tightening up the rules. One thing heading forwards from 2022, so obviously we'll be covering this in future webinars when we get closer to 2022, is they are finally looking to harmonise interest across all the different duties, and also a reform of penalties for late payment of tax liabilities. So the new rules, there's going to be a point-based system for submitting late returns, and there will be a percentage-based system for penalties. So instead of flat rate penalties, it's going to be a percent. So what the rules are going to be, it's 2% if you're late between 16 and 30 days, 4% if it's more than 30 days, and then on top of that, an extra 4% per year on a day-by-day basis for the penalties. So in the first year, you can end up with 10% penalty for 12 months of lateness. I guess you can say that's very similar to the 5% surcharges that you could face on IT self-assessment, and this is again just for late payment of tax. So you've got interest charges and penalty charges will be harmonised. This is not to do with incorrect tax returns or avoidance evasion. Any corrections, they will still be under the current 0 to 200% penalty regime, depending if it's UK or overseas. So we've covered some of this already, but the government have announced extra resources, extra funding is going to be put in place to increase the revenues HMRC bring in from tackling fraud and evasion and avoidance that they disagree with. They're recruiting new staff across compliance, and they're investing in IT systems as well to make it easier. We know everything's going digital, and there'll be more and more digital disclosures and digital returns coming for businesses over the next few years, and for individuals, landlords, and corporates will all eventually in the same position as the VAT for managing your digital returns. It will all become digital in the future. They're also looking to digitise business rates, and they're increasing and ensuring that any historic loan charge, disguised remuneration, and tax schemes are either caught and challenged, or the one thing, a bit more of a unique thing that the revenue are doing, which was announced a couple of months ago, is that they're also making more use of the Advertising Standards Authority rules. That if people are promoting and advertising tax avoidance that are not correct, the revenue will challenge those adverts and ask the advertising standards to remove those adverts from whichever source that they are put in. So that's another angle that they're looking to deter people from tax avoidance.
That's sorry. This is quite on the disguised remuneration loan charge schemes. This is a very good step, because the number of people that have come to us for help, all of them will say that, majority of them would say that, but we were explained that there are that this is fine, it should be okay. And then early intervention, I suppose if the people participating in the schemes, they are told early on that this is something that will be flagged up. We've always told clients or anyone that has come to us for advice is that these things eventually, you might have a good run with it, but eventually HMRC will catch up with you. So if they do catch up earlier in the process, and if they are sort of getting involved in the from the promotion side and saying that this is not right, then I think that would result in lesser people being caught at a very late stage, and they might sort of say, okay, well, I can walk away, and then it makes it easier for them to walk away. So let's say someone has been in this scheme for a number of years, and then HMRC catch up with them. Well, we've come across several cases. They want to settle. They want to be on the right track then and in the good books with HMRC, but then the amounts that they're being asked to pay to do that, it accumulates to such a significant number that's something that they can't afford.
Yes, indeed.
So all in all, this is a good step, and I think the digitalization of business rates, I certainly know for a number of clients this is really good, because rather than just chasing for information, we know that it's online. And the IT systems, I think they've been talking about making tax digital. It's been implemented for VATs. Now it's moving on to other tax areas. But overall, I think the objective, as you summed it up, is to sort of increase the tax yield and cover for the yield that was lost during this period.
Yes, it is. And just briefly on coming back on what you just mentioned then about loan charge, disguised remuneration, with the IR35 changes to coming in for large private companies as well from April, which follows on from the public service companies a few years ago. It had been postponed from last year to start from the 6th of April this year. With those IR35 challenges for smaller companies and status issues, there are people who are possibly advertising the it looks too good to be true scenarios with some umbrella companies or some ways of extracting funds from businesses or being paid. People just need to be very wary of what they're signing up to, what they're going into, and if people need advice or a second opinion, by all means they come to us. So I think in conclusion and summary from the talk today, the revenues certainly are going to be increasing their compliance activity post-COVID. The staff will be moving back from support work with COVID to tackling any evasion and fraud and compliance problems. There's going to be a new task force that's specifically going to be looking at COVID grants and bounce back loans, and just generally they're increasing the number of staff and investment to combat avoidance, evasion and non-compliance. If you'd like to contact me, please use the email d.jennings@Churchill-Tax-Advisors. And you can contact Imad. I think his internet is just wavering at the moment.
Sorry, Dave. Can you hear me now?
I can hear you now. Yes. Yep. So we can cover some Q&A as well.
Okay.
Did you want to say something there?
Yes, just a very brief summary. My conclusion on the whole presentation is if something is wrong, if there is a case that's hanging, if someone needs to come forward and get their tax affairs right, now is the best time to get it done, because the stance will start changing very, very soon. These are all early indicators of that, and I think we're seeing it in some cases as well already. So if there is anything, we should look to get it resolved as soon as possible.
Yeah. We've got a couple of questions that have come in, so we'll just briefly answer those before we close down today. One person's asked, do we think the new harmonisation, the change in penalties for late payment, will it be better than the old system? I think it'd be maybe fairer. Obviously, it's going to be based on the amount of tax that people will have paid. So if your tax liability is low, then you'll have a lower penalty payment to pay. So I think they're trying to recognise that it will be a fairer system, and equally there'll be more opportunities to maybe settle and pay with HMRC before the penalties start kicking in.
Dave, there's another question on bounce back loan.
Yeah.
Client is concerned that the company will struggle to pay the bounce back loan or refuse to pay at all. What would be the consequences for the director's personal tax position? Does he have to pay the bounce back loan from his own source? So, I mean, there are a lot of, in terms of the bounce back loans, there are a lot of options available. So there is this scheme called Pay As You Grow. So you can either only pay the interest, you can either ask for a further payment holiday for another 6 months, and then extend the loan for 10 years. So they have introduced a lot of measures. So it might, if we look at the overall loan and the way how flexible they are being, it would be too difficult for the company to pay. But if there is a position where they're not really going to pay, then I would say that HMRC haven't released exact details on how they will do it, but someone needs to be held accountable, and they normally, the director is the first person that gets questioned.
Yes, I mean, they've already got existing rules and legislation to do that. Inevitably, you know, if a company genuinely struggles, then you know, not everyone's going to obviously be penalised, and it depends whether there's been any personal guarantees with for the loan as well. If there isn't, then obviously there's no direct switch to the individual in that circumstance. It'd be up to the banks and HMRC to pursue under insolvency rules as well. If it's a genuine insolvency, then everything has to be under the correct act and rules before a company is liquidated and struck off. And obviously that needs to be signed off correctly. If the revenue would also look to see whether the applications themselves were genuine applications in the first place.
And the only thing I'll add to that, Dave, is, you know, they've given so many options. So the question of them not being able to afford, they really will have to justify that, because they can say, well, okay, we're giving, if you can't do it, we'll give you 6-month holiday. You can pay only interest. How about we extend it for 10 years? There are so many options that then it really needs to be looked at, and it needs to be justified. Okay, well, we've given you 10 years. You need to look at your expenses. They will, all of that can be scrutinized, and then only then, if they can show, well, we're generally struggling, and some people will, then that's a completely different case.
Yeah. Oh, obviously, they're going to be looking at potential fraud in some cases. Some will be fraudulent, and some will be genuine business failures, which, you know, can never be predicted. Right, thank you very much. We don't have time for any further questions this afternoon. Please join us again in a month's time for the next tax investigation webinar, and please join our colleagues in 2 weeks' time for a tax technical planning update. Otherwise, enjoy the rest of your day. If you're watching this recording, then enjoy the rest of your time, evening, weekend, depending when you're watching this. We'll see you again soon. Thank you.
Thank you.
Bye-bye.
Thanks. Take care. Bye.